Welcome back. Shares of Canada Goose are slipping, and it's been a difficult 52 weeks for this stock, to say the least. This comes after the apparel company slashed its full-year sales forecast. The stock is now trading at all-time low levels and could remain under pressure as economic uncertainty continues in some of its key markets. For more, let's bring in Zachary Warring. He's equity research analyst at CFRA. Zachary, thanks a lot for joining us. You have just recently cut your rating to hold, cut your price target to $11 from $12 per share. Your concern is margin compression and slowing brand momentum. Why don't you explain?
Yeah, thanks for having me. So, yeah, our thesis, we had a buy for about 6 months, thinking that maybe the worst was behind us with Canada Goose. And we just don't think that's the case anymore. Obviously, they've had a shift or a change up in leadership. They're bringing in a new CFO and moving their CFO to Asia. And we just think, along with macroeconomic conditions, it's not going to be just an easy, quick fix. It'll take some time, and we think their brand momentum is slowing.
How serious is the problem in China? I've heard it described a couple of different ways. Economic pressure in China can reduce sales, and less travel by Chinese tourists to places like Europe can also depress sales, because one material trend has been Chinese nationals buying the product when they travel outside of China. How concerning are trends in China?
Yeah, I mean, I think that's their number one issue. Obviously, that's probably why they, had a change up in leadership, and they're bringing their CFO over there. I think they know that it's a very important market for them. That's where they're going to get growth over the next few years. And so they're really focusing on that. The U.S. is obviously showing a decline in revenues. And that's part of our, we're seeing that around retail. So U.S. is obviously slowing down across retail. And so that's not just a Goose problem. That's, apparel retail, footwear retail problem. But yeah, we think China's their biggest market. Obviously, they've started opening stores in the last few years, direct-to-consumer stores, and they focused on just the U.S. and China. So they see those two markets as their biggest markets, obviously. And yeah, I mean, we think that with the slowdown in the U.S., China's got to be their number one focus, and that's clearly what they're doing here with the shakeup in leadership.
If we step back here, how much risk is inherent in a stock that you might describe as a one-product stock? The company obviously has a product line, but basically parkas is what this company does.
Yeah, so they've tried to step into shoes and footwear in recent years with not too much success. But like you said, their biggest product is their jackets, their parkas. And obviously this quarter isn't even their big quarter. It's the next quarter and even their fourth quarter. And so, this quarter was fine. We thought this quarter gross margins expanded significantly. Revenues were basically flat. They're up 1%. But obviously they see a slower global consumer, cutting their guidance significantly. We think the one product, they make a very good product. It's very expensive, so it targets a higher end consumer, which that was kind of our thesis when we upgraded to a buy 6 months ago, was we thought the high end consumer would end up doing better than the low and middle income. But their brand, I mean, we think it's their brand that's slowing. Their brand momentum is not what it used to be. They used to be able to grow 25+% revenues, and that's just not the case anymore. So. Yeah, I mean, that's kind of how we're looking at things right now, with the slowing U.S. consumer, and then Asia not as good as expected.
One of your peers, an analyst at Wells Fargo who covers the company, seems to have similar concerns as you do about slowing brand momentum. He phrases it this way: investors have begun to question whether Canada Goose has reached a point of saturation. Would you describe it that way as well? That many of the people out there who want to pay that kind of money for a parka have done so.
Yeah, I mean, I think absolutely, and I think that's kind of why you've seen their multiple compress significantly over the last 3 years as growth has slowed. And this is, their growth slowed during a strong economy in the U.S. Obviously, Asia, took a little bit longer to come back from COVID, but their sales revenues have declined significantly. The growth there, and this is all while other companies have proven that they can continue to grow their top line. With a significantly improved consumer in the U.S. over the last 2 or 3 years after COVID. So I would say that's pretty much spot on. Investors are starting to question if they can continue to grow their top line, and if they can, how much.
What are the peer stocks here? Do you compare this stock to other luxury brands stocks that are available to investors?
Yeah, I mean, it's hard to find an actual, good quality peer for them because they're so niche. You can't find many companies that sell strictly parkas or jackets to the high-end market. So, we just typically compare them to luxury, apparel and accessory goods. And they're just, they're not showing the same growth as these other companies. We like to use Lululemon because, they're both obviously based out of Canada, but they have similar target consumers. It's a little bit more high end for Canada Goose because their jackets run, significantly higher cost, but they're very similar in that they were, Lulu's proven that they can grow in other countries and through, harder times or tougher macroeconomic backdrops. But Goose has kind of taken the different path and not been able to show that they could grow significantly in these times. So, we've seen the multiple compress significantly over the last 3 years from, 40 to 50 times next year's earnings. And now it's back down to under 15 times. So, it's investors are souring and they're not going to return until they see growth return.